Step 4. Building good credit and managing loans. Building good credit and managing loans effectively are critical components of your financial journey. A healthy credit score allows you to secure better loan terms, lower interest rates, and gain access to financial opportunities that can accelerate your path to financial independence. On the other hand, poor credit management can lead to high borrowing costs, limited access to essential credit, and long-term financial challenges. This chapter will help you understand the importance of good credit, how to improve it, and how to strategically use credit and loans to build wealth. By taking the right approach to credit and loans, you can unlock financial opportunities that will help you move closer to your financial freedom goals. The importance of a good credit score. Why credit matters. Your credit score plays a pivotal role in your financial life. It serves as a snapshot of how reliably you manage borrowed money and reflects your ability to repay debt. Lenders rely on your credit score to assess the risk of lending you money, and it's a primary factor in determining the interest rates and loan terms they offer. The higher your credit score, the lower the risk you pose to lenders, which typically translates into more favorable borrowing conditions, such as lower interest rates and more flexible loan terms. Credit scores generally range from 300 to 850. A score above 700 is considered good, and scores above 750 are regarded as excellent. While the criteria for calculating credit scores may differ slightly across the three major credit bureaus, Equifax, Experian, and TransUnion, there are a few key factors that are consistently taken into account. The most significant factor is payment history, which makes up about 35% of your score. This reflects how reliably you pay bills on time and avoid missed or late payments. Next is credit utilization, which accounts for 30% of your score. This ratio measures how much of your available credit you are using relative to your credit limit. A lower utilization rate is considered more favorable because it suggests that you are not overly dependent on credit. The length of your credit history also plays a role in your score, making up 15%. A longer credit history indicates experience with managing credit responsibly, while a shorter history may be viewed as less stable. The types of credit you have make up 10% of your score. This looks at the diversity of your credit mix, such as credit cards, mortgages, and installment loans. A healthy mix of credit types can help boost your score. Finally, new credit inquiries and newly opened accounts contribute 10% to your score. Multiple recent credit inquiries or opening several accounts in a short period can signal risk to lenders, potentially lowering your score. Maintaining a good credit score is crucial for several reasons. One of the most immediate benefits is access to lower interest rates. For instance, if you have a credit score of 760, you may be able to secure a mortgage with a 3% interest rate, whereas someone with a score of 600 might be offered a rate closer to 5% or higher. Over time, this difference in interest rates can result in significant savings, especially for large loans such as mortgages or car loans. A strong credit score also improves your chances of being approved for loans and credit cards, and it can lead to more favorable terms. For example, you might qualify for larger loan amounts or longer repayment periods. Additionally, some auto and home insurance companies use your credit score to determine premiums. A higher credit score could result in lower insurance rates, which could save you money on both your car and home insurance. In addition to loans and insurance, your credit score can affect your career prospects. Some employers, particularly those in financial services or positions that involve handling sensitive information, may check your credit report as part of the hiring process. A poor credit score could raise concerns about your financial responsibility and negatively impact your chances of landing certain jobs, especially those with higher salaries or positions of trust. Your credit score is a critical aspect of your financial profile, influencing everything from loan approval and interest rates to insurance premiums and job opportunities. Building and maintaining a good credit score can save you money, improve your financial flexibility, and open up opportunities for your financial future. Understanding your credit report and how to improve it. What is a credit report? A credit report is an essential document that provides a detailed record of your credit history. It's maintained by the three major credit bureaus, Experian, TransUnion, and Equifax, and is used by lenders, insurers, and even some employers to evaluate your financial behavior and creditworthiness. The credit report includes important information about your credit accounts, such as credit cards, mortgages, student loans, car loans, and other forms of credit you have used or currently use. It details your payment history, including whether you have made payments on time, missed any payments, or defaulted on any accounts. Additionally, your credit report includes any public records related to your financial history, such as bankruptcies, foreclosures, or judgments against you. This information can significantly affect your credit score, which is a numerical representation of your creditworthiness, calculated based on the information in your credit report. Another important aspect of your credit report is credit inquiries. When a lender or company checks your credit before approving you for a loan or credit card, that is considered a hard inquiry, and it is recorded on your credit report. Too many hard inquiries in a short period can indicate financial instability and may negatively impact your score. However, some inquiries, like those made by you to check your own credit, are considered soft inquiries and do not affect your score. Because your credit report influences many aspects of your financial life, it's crucial to check it regularly for accuracy. Mistakes can happen, and inaccuracies, such as incorrectly reported late payments, duplicate accounts, or accounts that don't belong to you, can negatively impact your credit score. It's especially important to catch these errors early to prevent them from affecting your ability to obtain credit, secure favorable interest rates, or even qualify for housing. You are entitled to receive a free copy of your credit report from each of the 3 credit bureaus once a year. This can be done through the official website annualcreditreport.com, which is the only authorized source for free credit reports. By reviewing your credit report regularly, you can ensure that all the information is accurate, dispute any errors, and take steps to improve or maintain your credit standing. In summary, a credit report is a critical tool for understanding and managing your credit. It provides a detailed record of your credit history, influences your credit score, and plays a vital role in your financial future. Regularly monitoring your credit report helps you stay informed, protect your credit, and address any issues before they become larger problems. How to obtain and review your credit report. Obtaining and reviewing your credit report is an essential step in managing your credit and ensuring your financial health. To obtain your credit report, visit the official website, annualcreditreport.com, where you can request a free copy from each of the 3 major credit bureaus, Experian, TransUnion, and Equifax, once a year. It's a good idea to space out your requests throughout the year so that you can monitor your credit report regularly. Once you have obtained your credit report, carefully review each section. Start by going through the list of credit accounts reported. Check that all accounts are indeed yours and that the information matches your records. Pay special attention to any unfamiliar accounts or accounts that may have been opened in your name without your knowledge. If you find any discrepancies, it's crucial to contact the credit bureau immediately to dispute the error and investigate further. Next, review your payment history. Ensure that there are no incorrect late payments or missed payments. Even a small mistake, like a payment being marked as late when it was actually made on time, can significantly impact your credit score. If you find any errors, dispute them with the credit bureau, providing documentation if necessary, to have them corrected. In addition, check the section of your credit report that lists credit inquiries. Each time a lender checks your credit for a loan or credit card application, it counts as a hard inquiry. A large number of hard inquiries in a short period can signal financial distress and could cause a dip in your credit score. Review these inquiries carefully and ensure they were initiated by you. If you notice any inquiries you don't recognize, take action to verify their legitimacy and dispute any that are incorrect. Finally, examine the public records section of your credit report, which lists any bankruptcies, liens, judgments, or other legal actions taken against you. These can have a significant negative effect on your credit score and remain on your report for several years. If you find any errors or discrepancies in this section, take the necessary steps to dispute them. This may involve providing documentation or contacting the appropriate court or agency to correct the information. In the event that you identify errors or inaccuracies, it's important to take action immediately. You can file a dispute with the credit bureau online, by phone, or by mail. The bureau is required to investigate the dispute, typically within 30 days, and correct any errors if necessary. Keeping track of any disputes you file and the outcomes is important, as it helps ensure your credit report reflects an accurate history. By regularly reviewing your credit report and addressing any discrepancies, you can safeguard your credit score and financial future. Ensuring the accuracy of the information reported can help you avoid unnecessary damage to your credit and put you in a better position to qualify for loans, secure favorable interest rates, and maintain a healthy financial standing. Steps to improve your credit score. Improving your credit score is a gradual but essential process for securing better financial opportunities, and with some discipline and dedication, it can be achieved. The most critical step is ensuring that you pay your bills on time. Payment history accounts for the largest portion of your credit score, so consistently making timely payments is vital. Even a single late payment can stay on your credit report for up to 7 years, which can significantly damage your score. If you struggle to remember due dates, consider setting up automatic bill payments or use digital calendar reminders to stay on top of your obligations. Automating your payments not only ensures that you avoid late fees but also helps in building a positive payment history, which will improve your credit score over time. Another important factor in improving your credit score is reducing your credit utilization ratio. This ratio is the amount of credit you're using relative to your total credit limit, and it makes up a significant portion of your score. Experts recommend keeping your credit utilization below 30%, meaning that if you have a credit limit of $10,000, you should aim to use no more than $3,000. High credit utilization suggests that you may be financially stretched, which can negatively impact your credit score. If you have high credit balances, prioritize paying them down. If you have multiple credit cards, try to balance out your payments between them to ensure that no single card has an overly high utilization ratio, which can harm your score. It's also crucial to diversify your credit mix. A healthy credit mix includes different types of credit, such as credit cards, installment loans, like car loans or personal loans, and mortgages. Lenders favor applicants who show they can responsibly manage various types of credit because it suggests a well-rounded financial profile. However, while a mix of credit types is important, you shouldn't open unnecessary accounts just for the sake of variety. Only apply for new credit if it makes sense for your financial situation. Opening too many new accounts in a short period can negatively affect your score, so it's better to avoid unnecessary applications. Lastly, limiting new credit inquiries is an often overlooked but important part of improving your credit score. When you apply for new credit, a hard inquiry is made, and each inquiry can lower your score slightly. Multiple inquiries within a short time frame may indicate to lenders that you're in financial distress and actively seeking credit, which could harm your chances of approval. Therefore, before applying for a new credit card or loan, take a moment to evaluate whether it's truly necessary. If you already have a credit card that meets your needs, for example, it may not be worth applying for another one just to increase your available credit. Be strategic in your applications and apply for new credit only when it's essential to your financial goals. By focusing on these 4 key areas, paying your bills on time, reducing your credit utilization, diversifying your credit mix, and limiting new inquiries, you can gradually improve your credit score. It takes time, but with consistent effort, you'll not only raise your credit score but also build a solid foundation for achieving your financial goals. Strategic use of credit cards and loans. How credit cards can build your credit. Credit cards can be a powerful tool for building and maintaining good credit when used strategically and responsibly. One of the most effective ways to maximize the benefits of a credit card is to pay off your balance in full every month. By doing this, you avoid paying interest on your purchases, allowing you to leverage credit to build your score without accumulating unnecessary debt. This practice also helps keep your credit utilization ratio low, which is a crucial factor in determining your credit score. Lenders view lower utilization rates as a sign of responsible credit management, which can improve your chances of securing favorable loan terms in the future. Using credit responsibly also means only charging what you can afford to pay off when the bill is due. Overspending on a credit card can quickly lead to financial trouble, as high-interest debt can spiral out of control if not managed properly. A good rule of thumb is to treat your credit card like a debit card. Spend only what you have in your bank account to ensure you can pay off the balance in full. Additionally, keeping track of your spending habits and setting up alerts can help you stay on top of your payments and avoid late fees or penalties. Another key aspect of responsible credit card use is managing your credit utilization ratio. Credit utilization refers to the percentage of your available credit that you are using. For example, if you have a credit card with a $1,000 limit and a balance of $500, your utilization rate is 50%. Ideally, you should aim to keep this ratio below 30%, as a lower utilization rate signals to lenders that you are not overly reliant on credit and can manage your finances responsibly. If possible, making multiple payments throughout the month instead of waiting until your statement is due can help keep your utilization low and improve your credit score over time. Furthermore, consistent and responsible credit card usage can help you establish a positive credit history, which is essential for obtaining better financial opportunities in the future. A strong credit score can lead to lower interest rates on loans, better approval odds for mortgages, and even lower insurance premiums. It can also make it easier to rent an apartment or secure a job in industries where employers check credit reports. Ultimately, credit cards can be a valuable tool for building credit, but they must be used with discipline. By paying off your balance in full each month, keeping your utilization low, and only spending within your means, you can use credit to your advantage and strengthen your financial foundation. Using loans strategically. Loans can be a valuable financial tool when used strategically, helping individuals achieve significant life goals such as education, homeownership, and business growth. When used wisely, loans can create opportunities for financial advancement that might not otherwise be possible. For example, student loans can be a smart investment if they enable you to earn a degree that leads to higher-paying job opportunities. However, it's crucial to fully understand the terms of the loan, including interest rates and repayment schedules, to ensure that borrowing for education remains beneficial. Without a well-thought-out repayment plan, student loan debt can quickly become overwhelming, making it harder to achieve financial freedom. Similarly, mortgages allow individuals to purchase a home and build equity over time. Unlike renting, where payments do not contribute to ownership, a mortgage helps you accumulate wealth as you gradually pay down the loan. Additionally, home values often appreciate, meaning your home could increase in value over time, further enhancing your financial position. However, it is important to borrow responsibly. Taking on a mortgage that exceeds your financial means can lead to financial stress and difficulties in keeping up with monthly payments. Before taking on a mortgage, it is advisable to assess your budget, consider all associated costs, such as property taxes and maintenance, and choose a loan with favorable terms. Business loans can also be a powerful tool for entrepreneurs looking to start or expand a business. If you have a well-researched business idea and a clear strategy for generating revenue, a business loan can provide the capital needed to cover startup costs, invest in equipment, hire employees, or scale operations. When used effectively, a business loan can lead to significant financial success, allowing you to build wealth and achieve financial independence. However, it is essential to ensure that the loan amount aligns with your business's projected earnings and that you have a solid repayment plan in place. Taking on too much debt without a clear strategy for repayment can lead to financial strain and potential business failure. On the other hand, not all loans contribute to financial growth. High-interest loans, such as payday loans and credit card cash advances, should be avoided whenever possible. These loans often come with steep interest rates and fees, making it difficult to repay the borrowed amount without accumulating even more debt. Using high-interest loans for discretionary spending, such as vacations, luxury items, or entertainment, can quickly lead to a cycle of debt that becomes increasingly difficult to escape. Instead, borrowing should be reserved for investments that provide long-term financial benefits, such as education, home ownership, or business expansion. To use loans strategically, always evaluate whether the debt will improve your financial position in the long run. Before taking on any loan, consider alternative options such as saving in advance, seeking lower interest financing, or exploring grants and scholarships for education. Additionally, having a repayment plan in place before borrowing can help ensure that the loan remains a tool for financial growth rather than a source of financial burden. By borrowing responsibly and focusing on loans that contribute to wealth building, you can make debt work in your favor and avoid unnecessary financial stress. How to avoid common credit mistakes. Mistakes to avoid. There are several common credit mistakes that can have long-term consequences on your credit score and overall financial health. One of the most significant mistakes is only making the minimum payment on your credit card each month. While this might seem manageable in the short term, it leads to accumulating high interest charges, making it difficult to pay off your balance and keeping you in debt for much longer than necessary. The interest compounds over time, meaning you end up paying far more than you originally borrowed. Instead, it's crucial to pay more than the minimum, ideally, the full balance, to reduce your debt faster and avoid unnecessary interest costs. Another critical mistake is maxing out your credit cards, which significantly impacts your credit utilization ratio, the percentage of available credit you're using. A high utilization rate can lower your credit score and make lenders view you as a higher-risk borrower. It's recommended to keep your credit utilization below 30% of your total credit limit to maintain a healthy score. For example, if you have a credit card with a $10,000 limit, you should aim to keep your balance below $3,000. If your balance exceeds this amount, paying it down quickly can help prevent negative effects on your credit profile. Missing payments is another damaging mistake that can have serious consequences. Even a single late payment can remain on your credit report for years and lower your credit score. Late payments not only result in penalty fees and increased interest rates but can also make it harder to qualify for loans and credit in the future. If you accidentally miss a payment, it's important to act quickly. Contact your lender as soon as possible to explain the situation and request a goodwill adjustment. In some cases, creditors may be willing to remove the late payment from your record, especially if you have a good history of on-time payments. Additionally, frequently applying for new credit cards or loans within a short period can negatively affect your credit score. Each application results in a hard inquiry on your credit report, and too many inquiries in a short time frame can signal to lenders that you may be financially unstable. Instead of applying for multiple credit accounts at once, space out applications strategically and only apply for credit when necessary. By avoiding these common mistakes and adopting responsible credit habits, you can protect and improve your credit score. Maintaining a low credit utilization ratio, making timely payments, and limiting unnecessary credit inquiries will ensure that you have better financial opportunities, such as lower interest rates on loans and credit cards, higher credit limits, and improved overall financial stability. When to use loans as a tool for growth versus a burden. Using loans for growth. Loans can be a powerful tool for growth when used strategically, helping individuals and businesses achieve financial goals they might not otherwise be able to reach. Educational loans are one of the most common examples of using borrowed money to invest in future growth. By taking out a loan to finance higher education or vocational training, individuals can enhance their skills and qualifications, leading to higher earning potential in the long term. This type of borrowing is often viewed as an investment, as it increases a person's value in the job market and improves the chances of landing higher-paying positions. However, it's crucial to be mindful of the terms and interest rates of such loans to avoid being burdened with excessive debt after graduation. Similarly, mortgage loans provide an opportunity for individuals to invest in real estate, a key asset that often appreciates over time. A home loan allows people to become homeowners, building equity as they make payments. Real estate is generally considered a long-term investment that can offer both stability and financial growth, as property values can increase over time. By purchasing a home with a mortgage loan, individuals are not only securing a place to live, but they are also investing in an asset that could potentially provide significant returns in the future. Business loans are another example of using borrowed money for growth. Entrepreneurs and business owners can secure financing to start or expand their business ventures. This type of loan can be used to cover expenses such as equipment purchases, inventory, marketing efforts, or hiring additional staff. The key to successfully using a business loan is having a well-thought-out business plan. A clear strategy for growth and profitability is essential to ensure that the borrowed funds are used wisely and lead to a sustainable, thriving business. Properly managing business loans can help entrepreneurs scale their operations, capture new markets, and ultimately increase their revenue and success over time. In all these cases, loans can act as a catalyst for growth, but they should be approached with caution. Borrowing money comes with responsibilities, and it's important to have a clear plan in place to ensure that the loans lead to tangible benefits and not financial setbacks. Loans as a burden. Loans can quickly become a financial burden if they are not used responsibly, and this is especially true when they are used for unnecessary purchases or taken with high-interest terms. Using loans or credit for non-essential items such as luxury goods, vacations, or other discretionary spending may seem like an easy way to enjoy the present, but it can create long-term financial challenges. These purchases do not contribute to building wealth or increasing financial stability, yet the debt incurred to fund them continues to grow. This can lead to accumulating debt that is difficult to repay, all while the borrower remains stuck in a cycle of interest payments without tangible returns on their spending. Additionally, loans with high interest rates, such as payday loans or credit cards with high APRs, can add an even greater burden to the borrower's finances. These types of loans typically come with exorbitant fees and interest charges that quickly compound, leading to much higher total repayment amounts than originally borrowed. The higher the interest rate, the faster the balance grows, and the longer it takes to pay off the loan. For instance, a payday loan may seem like a quick solution for short-term cash flow problems, but the high interest rate and short repayment term can make it incredibly difficult to clear the debt, often forcing borrowers into a cycle of borrowing from one source to pay off another. Taking on high-interest debt or using loans for non-essential purchases can also prevent people from using credit responsibly, which could negatively affect their credit score over time. It can become increasingly difficult to meet monthly payments, resulting in late fees, increased interest, and potential damage to your credit history. This not only makes it harder to secure loans in the future, but it can also limit access to opportunities that require a good credit score, such as purchasing a home or securing lower interest rates for car loans. To prevent loans from becoming a burden, it's important to use credit strategically. Borrowing for purposes that add long-term value, like funding education, purchasing a home, or starting a business, can help build wealth and improve financial security. However, using credit for short-term pleasures or high-interest debt can undermine your financial health and make it difficult to achieve long-term goals. Therefore, it is crucial to have a clear understanding of the loans you're taking out, ensuring they align with your long-term financial objectives and that you are fully prepared to manage the repayment process. The bottom line. By following these steps to understand, manage, and strategically use credit, you can build a strong credit profile and make loans work for you rather than against you, setting you up for long-term financial success.